Hey everyone, welcome back. Today we're going to be doing something a bit different. We're going to be going over how to build a trade plan and what your trade plan should have in it, regardless of what strategy you trade. I'm going to give you basically a starting guideline, and then based on whatever strategy or whatever time frames you trade, you'll basically tailor fit it to yourself. Now, if you already haven't, definitely hit that subscribe button. And definitely stay to the end so you don't just get some of the information. So the very first thing we're going to look at is your higher time frame directional bias. When I say higher time frame, this is going to change for people. Are you a scalper? Are you a day trader? Are you a swing trader? If you're a swing trader, you'll likely be more reliant on monthly and weekly trends, basically. If you're a day trader, the majority of the people rely on daily or 4-hour. I personally use daily. So that's kind of the starting point. So we're going to go higher time frame direction. This is actually not even the starting point. This is actually the second point. We're going to go back to the starting point after this. So higher time frame direction. How are you getting your directional bias? So, you know what? Let's just do part one before I forget. And part one is market conditions. And this is a very important part that not a lot of people teach. You should have an idea. Okay. All right. You should have an idea if you're consolidating or if you're trending. So right now we are consolidating bearish. So market conditions. Consolidating or trending. Based on what kind of market conditions you're in, you're likely going to change your approach, you're going to change your targeting, and you're going to change your directional bias a lot more. In a consolidation market or a liquidity market, you're going to find yourself being able to go either direction a lot more, whereas when the market is trending, you're going to be able to go pretty much one direction most days for the highest probability setups. So this one I'm going to kind of leave to you, however you want to decide. This is again going to change based on what system you trade, what time frames. So that one I'll totally leave up to you. For directional bias, there's a couple ways of doing it. So for me, I have a rule that I need either 2 breaks or 2 respects of higher time frame liquidity. So if I get 1 break, 2 break, that makes me bullish. Now, the other way I could do it is if I have 2 respects of higher time frame liquidities without breaks. That to me is still confirming a trend change. That's basically looking at the other end of the candle. The other way is obviously using fractals or some market structure that you may have designed yourself, or whatever your rules for market structure may be. It really doesn't matter. For me, I like to see body breaks. So set of body breaks there, set of body breaks there. That makes me bearish. Overall, I am bullish on the weekly or the monthly. I know that this is likely a pullback till we realign. I also know that looking at my current market conditions that we are consolidating, but we're consolidating bearish. How I determine this is we're not really breaking with bodies. Aside from this body break, the rest of the breaks we're getting are all with wicks. So we're barely breaking. That makes me a consolidating market. Whereas when we are trending, it's just, I would say right around here, it starts kind of breaking out and starts trending. But you can kind of see there's consistent body breaks, and you're breaking. Like, you're very obviously trending. So it's a lot different. You can just look at the candlestick language. So how are you getting your directional bias? Okay. Whoops. Let's actually click on that. All right, so is it market structure, liquidity, moving averages. By the way, there's in trading, there's really no right or wrong way. There's what works for you and what you have data on working. You'll see people saying this doesn't work or that works. At the end of the day, if you've tested it, over 500 trades and you're able to make money with the system, it's a system that works for you. If it doesn't work for someone else, that's fine. So just kind of ignore the naysayers, and if it's working, keep doing it. If it's not, change out the things that are working. So market structure, liquidity, moving averages, candlestick language. Pretty basic stuff, right? And we're gonna pretend I know how to spell. All right. So, all right, we're just gonna space these out a bit. So the higher time frame direction. Now, for myself, I use daily. You may choose to use 4 hour. Maybe you're more of a scalper and you choose to use hourly and 5 minute. That's completely up to you, depending on your style of trading, I guess. I don't use the 4 hour for a whole lot. I pull the odd liquidity level off it. So for me, I use daily. My combination with daily is 1 hour. So daily's kind of my higher time frame. The hourly is more my medium time frame. And then I use 15 and 5. No directional bias comes off the 15 or the 5, obviously. They're more just supporting in the direction I already want to go for whatever reason I want to go. So that's kind of the higher time frame direction. And then we have the middle time frame. Some people call this the trading time frame. For most people, this is between 15 minute to 1 hour. I would say this is this is more of a realignment, I guess you would say. So for me, it all comes down to if the market is trending and my daily is looking like this, I have to understand what phase I'm in. Am I currently in the bullish phase, or am I currently in the pullback phase? So for the sake of this video, we're just going to keep things simple. Let's say we hit a level of liquidity here. Our expansion's finished, our contraction begins. In this part, I use mostly the daily direction. If 1 hour structure starts to form down and it's from a level I expect a retracement, generally the hourly is going to start producing order flow long before the daily. So this is where the medium time frame kind of comes in. You're likely not going to want to wait for 4 bearish daily candles before you realize you could sell. So the medium time frame is used 2 ways. So again, are you pro? This is, by the way, this is all for trending markets. Liquidity markets have their own rules. We're not going to get into that too much this video, otherwise we'll be here for hours. Okay, so pro trend or counter trend. So same difference. However you get your structure on the daily or the 4 hour, you would use the same for the medium time frame or the moving averages, however you might do it. Again, you need to understand if you're pro trend or counter trend. Pro trend, target daily targets. All right. Counter trend, target first possible reactive zone, manage more aggressively. So pretty straightforward. Obviously the trending market conditions, again, have their own rules. The liquidity market conditions will have their own rules. All right. And same thing. This you need to differentiate. You need to differentiate which phase you're in. Are you pro trend or are you counter trend? This is a big thing. A lot of people get lost on which way to go, and usually, the 5 and the 15 minute or whatever, direction's really not going to come off it most days. Unless you're in a news release situation, and a liquidity market, those aren't going to do a lot for you in a directional sense. So in a trending market, you're again leaning to your higher time frame and using the medium time frame or the supporting time frame, basically in conjunction with that. So again, pro trend or counter trend, pretty straightforward here, nothing different. So same thing, I should actually add directional, bias, and then it's market, structure, MAs, candlestick, language, liquidity levels. All right, so pretty straightforward. And we're just gonna make this generic because again, I don't know what everyone trades. So, one thing I do want to mention is, I guess this won't matter for everyone, but I'm gonna add it in. Are you running efficient or inefficient? If you're running efficient, the market's less likely to come back. If you're running inefficient, that could signal one of two things. Either the market's highly likely to come back, or price is barely pulling back and you have a lot of momentum, in which case you will basically come back to this another day to rebalance, and this will usually be on a higher time frame. So we could pretty much say the same thing here. I don't really look at efficiency and inefficiency too much below the 1 hour time frame, but same thing. I think some of you guys use pricing, premium, discount. If that's your thing, you can add that in here too. I personally don't use the concept. I use efficiency and inefficiency. There's gotta be also points of interest. Points of interest. So you'll have, I'm gonna list off whatever everyone uses. So you have support, resistance, maybe you have supply, demand, maybe you have liquidity levels, and maybe you have fib levels, and you'll likely have, we already got liquidity levels, okay, and you might have imbalance levels, depending if that's part of your plan or not. So these are all points of interest, possible reactional areas. These are areas we'd expect reactions. Again, different for different strategies, areas of reactions. For the middle time frame, it's going to be the exact same thing. Yeah, I might have did this a little backwards, but that's okay. For the middle time frame, it's going to be the exact same thing. So from your points of interest, generally, let's actually, this is a little weird doing it generic, because I don't even trade support and resistance, but I know a lot of our following does, and some of the people that asked, so I thought I would incorporate it. Okay, so So for these points of interest, this is generally where you're going to want to decide, based on your reaction, what the market's likely to do from there. Are we going to continue? Are we going to pull back? Is this a complete reversal area? Again, this is going to be up to you guys and what you do here. Now, a lot of people use engulfing candles. A lot of people use wicks. A lot of people use chalks or bosses or whatever. However you want to do it, what we're going to say here is look for reaction. And realignment. So again, realignment, that's gonna come in different forms, but maybe I can kind of give you guys an example. And I'm going with the more generic trading styles, because essentially it really doesn't differ that much from trading style to trading style. It's always going to be directional bias, medium time frame realignment, and it's going to be your entry trigger and management. With a little bit of this and that. Aside from that, it's generally all the same. Like, yes, you may have, different rules, but the plan itself doesn't really change. So, okay. So, at your POIs, look for reactions or realignment. How does that look? We could actually kind of give you an example. Price is trending. Alright, let's say again you hit whatever, a level of liquidity or support or resistance or supply to the left or whatever, you get a reaction. On your medium time frame, you may say something along the lines of, let's actually change that to red. I need maybe 2 breaks of structure before I am willing to sell. Or maybe I need a, Or maybe I need a break of structure, pullback, and the second break of structure maybe needs to have imbalance. Or you need basically engulfing candle, pullback, engulfing candle, or something. Whatever your rules may be, there needs to be a way of realigning your direction. So this could come from multiple structure breaks. What's going to happen is at some point you're going to hit a level and you need to determine, this could be a demand, this could be a support, this could be a liquidity level. And you need to determine what's determining that this is bottom. Obviously, you're not going to want to just hit buy at your level. Something needs to show you that price is maybe realigning. Maybe it's, for you trend line guys, maybe it's a trend line. Maybe, you hit your 50 moving average on the daily or the 4 hour or whatever. Maybe you have 2 breaks of structure. There needs to be a rule of how you realign. So for me, it's usually, there's a couple ways. One way is I hit a liquidity level that's higher time frame or medium time frame, and I respect that liquidity level twice. Or the other way is I break structure. I also use some candlesticks. In a simple sense, we can just say I like to see breaks with imbalance. That's kind of keeping it simple and generic. So these are kind of my ways of realigning. whatever your realignment needs to look like. So what that means is this direction will continue until you hit a level and your realignment rules are met. And if these rules are not met, you would just keep selling to your next point of interest. So again, as different as trading is and as many rules as there is, and there's a lot of very generic do's and don'ts to it as well. Obviously, everyone's strategy is custom tailored to themselves based on how you act in all this. Okay, so that's kind of, this is very generic, but the next thing you want to get into is entry time frame. For me, that's 1 and 5 minute, depending on the setup. Sometimes I'll even take 15-minute. Really depends on the setup. I'm not against the higher time frame entry or medium time frame entry, I guess. Entry trigger. Again, candlesticks, chalks, bosses, engulfing candles, pin bars. I don't know who else uses what. I have my own candlestick language I use that's basically none of those. But for me, it would be like candlesticks and breaks of structure, respect of liquidity levels. As far as like pin bars and chalks and all that, I don't really use them that way, but that's my entry trigger. So let's just kind of talk about this. So we're just going to keep using the same example. Daily's bullish. Your level came and got hit. Whoa, maybe a little smaller. So this is whatever support turn, no, resistance turn support, I believe. Let's say this level holds. We're gonna change this to different color. All right, cool. So price hits something to the left, your support or resistance or liquidity or whatever, it doesn't really matter. It hits something, you expect a reaction. So at first, this is your medium time frame in here. And this is obviously very textbook. The market's not going to be this nice to you, especially if you look at it right now. But at this level, I need to see realignment. Now that realignment happened, maybe we have another level here where you get your candlestick pattern or your pin bar or your boss or chalk or whatever. And essentially it would just be, we're now pro trend. I would line up. So you can kind of see how the mechanics of any trade system works. This is my point of interest. My trigger for realignment is the medium time frame has to do ABC. It'll be one of those things, you know, it'll be different things for different people, but once the medium time frame lined up, you would pull a medium time frame level, you know, 5, 15, 1 hour. And at that point, you need an entry trigger. So that's kind of the consensus of it. Now, from here, you would have to have management rules. Okay. So you shouldn't ever take more than 3 losses in a day. That's a personal rule I live by. Usually if you took 3 losses, maybe you're on the wrong side of things and you're not going to be in a good headspace. Just let the market go. On the other side of the spectrum, Maybe you're willing to take more than three losses and go to 4 or 5, but you're only risking, 0.2% or something. That's totally up to you. For me, I do 3 losses max. For winning trades, I do 2 wins max, and I walk away. Now, if I lose one and I break even twice, I'll kind of basically look at my headspace and see how I'm feeling. If I feel like I'm, not all there or a little bit frustrated, I'll end the day. If I feel like I'm still in a good headspace, I will maybe take one more. So 2 wins or 3 losses. That's kind of my maxes. You should have small risk. Now, small risk isn't going to differ from you based on your strategy. Some of you small risk maybe 1%. Some of you small risk maybe 5%. Reason I say 5% can be small risk is some people swing trade and hold for a week. There's nothing wrong with risking 5% in that scenario. Obviously, props, I would say props for day trading, I would say probably 0.25 to 0.5. For swing, probably 0.5 to 1. So this is kind of your risk side of things. So you should have a walkaway point, how many trades you're willing to lose, how many trades you should willing to walk away after how many trades you win. The reason you should have a walkaway point for wins is, let's say you won 2 trades today and you're up 5R. Statistically, a lot of people that keep trading are known to give back all their profits. This is a known statistics. Brokers share it, prop firms share it. So it's a good rule. It's a good rule set to basically know when you're going to walk away. You should also have TP rules. So this is, again, pro or counter trend. Different rules will be there. Maybe you're running the daily high. Maybe you're going to the first support resistance, supply demand, liquidity, whatever. You should have basically an idea of how you're going to TP or hard TP at a certain risk reward. I don't like this personally because let's say you're going for a 3 risk reward consistently, but there's a highly reactive zone at 2.5R and you're likely to give back your hard-earned profits. Be very careful with that one. I don't like the hard TP, so I always go for reactive levels. You should have break-even rules. This will differ from person to person. You might break even at 2R, you might break even at 1.5R, you might break even at 2 ranges, you might break even at 20 pips. However you want to do it, you got to have break-even rules. So pips, RR, or 2 breaks, however you want to do it. There needs to be break-even rules. Partials, all depends if you're a partial type of person or not. If my trade's 2 to 3R, I don't take partials. If I'm going for like a 4 or 5R, I will definitely take 30% off at 3R and go break even, just in case the trade doesn't work out. So again, partials are up to you. You can see how generic I've kept this, and that is because this is how simple it can be. There's a lot of rules within rules. There's understanding your market conditions better. There's also going back and analyzing data and seeing, hey, maybe I take a lot of losses when I trade the 5-minute time frame and I should only use the 15-minute or the 1 hour as my medium time frame. That's totally up to you. Or maybe I lose a lot on the 1 minute and I should look for 5-minute entries. Your data will tell you. But this is kind of the generic overview of how your trade plan could look. And if you don't know where to start, this will basically give you a starting point. yeah, I'm not going to drag this out too much longer. If you guys have any questions, feel free to ask. If you didn't hit the subscribe button already, definitely do. Yeah, I hope this helps you guys out. Like I said, feel free to reach out if there's questions. And yeah, I will see you guys in the next video.